Welcome to Tech Money Madness, your daily U.S. stock market podcast. It's June 23, 2026, and today we are doing a deep dive into the daily market briefing.
Hey everyone, great to be here.
So usually when you check a weather app, you expect a pretty clear answer. Like it says there's a torrential downpour, you just grab an umbrella.
Right, it's binary.
Exactly. But imagine looking at that app, seeing a severe flood warning, and then you look out your window to see blinding sunshine and a completely dry street.
Yeah, you're just standing there holding an umbrella under a cloudless sky.
Entirely disoriented.
Yeah.
And that split reality feeling, that's exactly what we're deciphering in today's deep dive. Our mission today is to tear into a single day of trading that feels, well, totally contradictory.
It really does. It's the absolute definition of a bifurcated market.
Because we've got staggering, record-breaking tech gains just violently colliding with recession-level economic warnings. I mean, on the surface, the daily tape was mostly red.
Yeah, it was a mixed, mostly down day for sure.
The S&P 500, the Nasdaq, and the Dow Jones Industrial Average, they all closed lower today.
And that was largely dragged down by a sudden, pretty aggressive semiconductor sell-off. The briefing attributes this directly to mounting concerns over just how much money is being spent on AI.
The capital expenditure is just massive right now.
It's astronomical. Wall Street is suddenly getting anxious about the velocity of that spending. We are seeing a major tug-of-war between the futuristic narrative driving these valuations and the fundamental physical reality of the broader economy.
And the duality within the tech sector itself is what makes it so baffling to me. Okay, let's unpack this. The broader market is tumbling on these AI spending fears. The Dow is taking a hit. Yet inside that very same sector, specific AI players are posting completely face-melting numbers.
Oh, absolutely.
Like the daily gainers list is dominated by Taiwan semiconductor manufacturing, Western Digital, and the absolute standout today, Micron technology.
Micron is just on another planet right now.
It really is. Their stock has surged an unbelievable 861% over the past year.
Which is just staggering to even say out loud.
And analysts are setting a $1,500 price target, which implies, what, another 30% upside from here. It's like a gold rush where investors are suddenly terrified they bought too many shovels, yet the best shovel makers are still selling out entirely.
That's a great analogy. To understand an 861% return in 12 months, you really have to look at the physical bottleneck of artificial intelligence.
Right.
Because everyone naturally focuses on the compute power, right? The GPUs processing all the data. But AI models are incredibly memory intensive. They require high bandwidth memory, or HBM, just to feed data to those processors fast enough.
And making that memory is not easy.
It's incredibly difficult. Manufacturing HBM involves physically stacking microscopic memory chips on top of each other, and the failure rate, what the industry calls the yield loss, is notoriously high.
So they throw out a lot of bad chips.
Exactly. But Micron has figured out how to manufacture these stacks more efficiently than almost anyone else out there. That makes them the ultimate choke point provider in the AI supply chain.
So the market isn't just buying their stock, they're pricing in a monopoly.
Yeah, a monopoly on a critical physical constraint.
That perfectly explains Cerebras, too. The briefing notes they just reported a 92% revenue growth in their first earnings report since going public.
92%. Just incredible.
Purely driven by strong demand for their AI-focused chips. I mean, their entire architectural premise is bypassing traditional chip limitations by building wafer-scale engines.
Literally massive dinner plate-sized chips.
Yeah, dedicated solely to AI workloads. The demand for that specific hardware is insatiable. But then, we flip the page in the briefing, and there's the casualty list. AMD, Apple, and Intel are the big losers today.
What's fascinating here is how Intel's situation highlights the brutal gladiatorial physics of semiconductor manufacturing right now.
It really is a battle.
The briefing points out this intense competitive battle between NVDA and Intel. Intel is currently entering what's called risk production for its advanced 18AP process node.
Right, risk production, which basically means they are moving forward without a safety net.
Exactly. To regain ground lost to NVIDIA and TSMC, Intel is forced to push wafers through their fabrication plants using this new node before the manufacturing recipe is fully proven.
I was reading that, and it's basically the equivalent of a massive industrial bakery deciding to mix and bake 10,000 wedding cakes before the head chef has even tasted a single cupcake to see if the batter works.
That's exactly it.
If the temperature is off by a fraction of a degree, or, the lithography fails to etch the transistors perfectly, They have to throw out billions of dollars worth of silicon.
And the market is looking at that capital risk and fleeing. Traders are heavily punishing legacy players who are forced to take these massive, costly leaps just to stay relevant.
Which is driving a lot of volatility.
Huge volatility. The briefing explicitly notes that traders are finding cheap derivative plays to short the broader chip sector. They're betting that the overarching AI narrative has drastically outpaced the fundamental math of what these companies can actually deliver.
Even though NVIDIA, Amazon, and Microsoft remain among the most active stocks.
Right, but underneath those titans, the confidence in the rest of the sector is fracturing. It's all narrative over fundamentals right now.
But that fracturing in tech confidence is nothing compared to the macroeconomic data buried in this same June 23rd briefing.
Yeah, the macro picture is grim.
Because if we step away from wafer-scale engines and high-bandwidth memory for a second and look at Main Street, the physical U.S. economy is flashing severe warning signs. How do these multi-billion-dollar tech valuations make sense when regular people are struggling?
They don't, really.
The S&P is reporting in the briefing that U.S. factory job cuts in June are nearing levels we haven't witnessed since the 2008 financial crisis and the peak of the COVID pandemic.
Which is a terrifying metric.
And we are also seeing a corresponding active decline in consumer spending, people just buying less stuff.
When you see factory jobs vanish at a 2008 level pace, you are looking at a hard stop in industrial demand. I mean, factory managers don't cut shifts unless forward orders have completely dried up. It indicates that you, the consumer, at the end of the supply chain, have exhausted your discretionary capital and stopped buying physical goods.
But here's where it gets really interesting, because the briefing contains a massive contradiction on that front.
Oh, the FedEx numbers.
Yes. If factory jobs are plummeting to crisis levels and consumer spending is dying, how did FedEx just post incredibly strong fiscal fourth quarter earnings?
Right.
And not just overall earnings, but driven specifically by its freight business. If nobody is making or buying anything, if the assembly lines are stopping and the malls are empty, what exactly is FedEx hauling across the country that's driving up their profit margins?
It's such a great question. You're looking at the fundamental disconnect between leading and trailing economic data.
Okay, break that down for us.
FedEx's fiscal fourth quarter represents the freight volumes and corporate contracts signed and fulfilled over the previous 3 to 6 months. They are reporting the revenue of an economy that essentially no longer exists.
Oh, wow. So those trucks were full of inventory ordered before the consumer hit a wall.
Exactly. Or, and this is happening a lot, they are currently moving excess inventory in reverse.
Like returns.
Yeah, shipping unsold goods from regional distribution centers back to massive centralized storage hubs to cut warehousing costs. FedEx gets paid per mile either way.
Right.
But those June factory job cuts, that's a leading indicator. That tells us the forward pipeline for the next 2 quarters is already empty. The industrial engine is idling.
Which makes the Federal Reserve's projected response completely illogical.
The tightening cycle.
Yeah, the briefing states analysts still expect the Fed to continue its monetary policy tightening, potentially delivering another rate hike soon.
Which is a tough pill to swallow.
If the consumer is tapped out and factories are bleeding jobs at crisis levels, further increasing the cost of borrowing is going to crush whatever is left of the industrial sector. Why would the Fed risk a deep structural recession when the spending data shows inflation is likely going to cure itself as demand collapses?
Well, the Fed doesn't believe inflation will cure itself entirely. They are looking at a bifurcated inflation model.
Meaning goods versus services.
Exactly. Physical goods inflation is dropping as consumer demand craters, which is why those factories are hurting. But services, inflation, housing, insurance premiums, those remain incredibly sticky.
They just won't come down.
No, they won't. If the Fed cuts rates now, or even pauses, they risk reigniting the housing market and cementing a permanent baseline of inflation.
So they're stuck.
They are staring down the barrel of stagflation, shrinking industrial output coupled with high living costs. They're basically forced to keep tightening, choosing to sacrifice the factory floor to ensure they break the back of services inflation before it becomes fully entrenched.
Man, that fear of a shrinking volatile economy is exactly why energy policy is suddenly on the front burner today, too. Because the U.S. economy doesn't exist in a vacuum.
No, it's deeply tied to global energy.
A factory in Ohio that's already cutting shifts can't afford a sudden arbitrary spike in power or shipping costs. And the global events in this briefing are throwing gasoline on the market's volatility fire.
It's like someone is violently shaking the global energy chessboard.
Exactly. Now, we want to be very clear with you listening. We're presenting the raw data exactly as the briefing lays it out, neutrally, just reporting the facts of the source.
Right, no sides here, just the data.
First, the U.S. has issued sweeping Iran oil sanctions waivers, which unlocks billions in revenue for Tehran. Second, the Trump administration plans to loan $17 billion to speed up the deployment of 10 big nuclear reactors across the U.S.
Massive domestic energy pivot.
Huge.
Hmm?
And third, there is a massive evacuation plan, currently beginning in the Strait of Hormuz, with over 11,000 stranded seafarers expected to exit the Persian Gulf.
If we connect this to the bigger picture, the mechanical collision of those events in the commodities market is immense. Let's start with the Strait of Hormuz.
Yeah, why does that matter so much to the U.S. market?
Roughly 20% of total global oil consumption physically passes through that maritime choke point. When 11,000 seafarers are evacuated, it injects massive uncertainty and fundamentally alters the risk calculus of maritime insurers.
Because it's suddenly a war zone.
Right. And the moment insurance premiums for supertanker hulls cross a certain threshold, shipping companies simply refuse the transit. You don't even need a physical blockade. The financial architecture of shipping freezes the oil in place.
So you have a massive supply shock, tightening the market, but simultaneously, the U.S. issuing sanctions waivers for Iranian oil floods the market with physical barrels.
It's complete whiplash.
You have one mechanism violently choking supply and another opening the taps. The futures traders trying to price a barrel of oil for next month must be completely paralyzed trying to calculate the net effect.
Paralyzed, resulting in wild, unpredictable price swings. And that trickles right back down to the balance sheets of those struggling U.S. factories and volatile stock prices we were just talking about.
Which explains the nuclear push.
Yes. The domestic response, that $17 billion loan for 10 nuclear reactors, is a clear admission of this vulnerability. That capital isn't a short-term fix for today's market. That is a multi-decade structural pivot.
And it directly ties back to the tech sector, right? Those massive wafer-scale AI engines Cerebras is building and the server farms NVDA is supplying, they require a staggering amount of baseline power.
An unbelievable amount of electricity.
Tech companies can't rely on a vulnerable global oil supply chain to power the AI revolution.
No, they require sovereign, uninterrupted energy. The market is pricing in the reality that the infrastructure required to support the next decade of technology demands a completely insulated domestic power grid.
Which honestly brings our entire conversation today full circle. Because given all these economic crisis warnings and the geopolitical tension we just discussed, the sheer audacity of the moves being made by mega-cap tech companies right now is baffling.
It's hard to wrap your head around.
We are looking at a real economy where factories are shutting down, the Fed is threatening to hike borrowing costs into a recession, and global shipping lanes are freezing up. And amidst all that heavy, restrictive macro reality, we get these two wild growth stock moves in the briefing today.
Oh, Meta and SpaceX.
Yeah, Meta is pushing further into wearables by announcing a new line of smart glasses starting at $299.
Right into the teeth of a consumer spending slowdown.
Exactly. And SpaceX, less than 2 weeks after their IPO, just raised a mind-boggling $25 billion. Not by issuing more equity, but in a debt sale.
Executing a $25 billion debt sale immediately after an IPO in a high interest rate environment where the Fed might hike again. I mean, that is an astonishing financial maneuver.
It really is. So what does this all mean? Imagine being an investor right now. The real economy is flashing red. The S&P is telling you industrial output is crashing. The geopolitical board is incredibly unstable. Yet you are willingly watching SpaceX take on $25 billion in debt to build rockets, and you're backing Meta's bet on face computers. Are these companies just immune to the macro environment?
This raises an important question, and it perfectly encapsulates the narrative over fundamentals theme of today's briefing.
They really are in two different worlds.
Exactly. Investors are willing to fund massive futuristic visions, space exploration, AI dominance, wearables entirely divorced from the day-to-day economic slowdown. It's a market operating in two completely separate realities.
A parallel reality powered by narrative velocity.
Right. The capital flowing into SpaceX, Meta, Cerebras, and Micron is not an investment in the economy of June 2026. It is a bet that the technological paradigm shift will be so lucrative that it renders current economic cycles irrelevant. The investors buying that $25 billion in debt do not care if consumer spending dips this quarter.
If your company has a compelling sci-fi vision, you apparently have access to infinite capital. But if you're a legacy company manufacturing physical goods subject to inflation and shipping lanes, you are fighting for survival.
But the danger for anyone navigating this market is forgetting that narratives can violently snap. The stock price of a company operating on narrative alone will eventually be forced to reconcile with its actual fundamental earnings.
Well, it's an incredible whiplash of data to process today. We're tracking a market where the major indexes fall on AI fears, yet individual players like Cerebras and Micron post historic gains.
Right.
Where FedEx thrives while factory jobs hit crisis levels,
hmm
and where global tensions simmer while tech giants borrow billions for the future.
In a market driven by narrative, the most crucial skill you can have is stepping back, looking at the fundamentals, and understanding why the money is moving the way it is.
And that leaves you, the listener, with one massive, unavoidable question to consider today. If the stock market continues to reward these futuristic tech narratives, while the actual U.S. economy, factory jobs, consumer spending contracts to crisis levels, what happens on the inevitable day that those two entirely different realities are forced to finally reconcile? When the weather app insists on perpetual sunshine, but the floodwaters are already cresting the driveway.
That convergence is the breaking point every investor must prepare for.
That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.